Not too long ago, before the word startup was coined, business was about making money. It was about profits. See, business used to be a lot simpler than it is today. You built something, you sold that something, you made money from that sale, and then you used that money to grow your company so that you could build more of that something and sell more of that something, and so on and so forth. It was a cycle. It was predictable and reliable and consistent, but that's not the way that business works anymore. At least not for startups. See, today we can take all of this and replace it with this. All of a sudden, growth isn't dependent upon profits or losses. It's dependent upon how much money a startup can raise from its investors. And this new growth strategy has created a new category: loss-making startups. Now, contrary to what it might sound like, loss-making isn't necessarily a bad thing. I know when we think of the word loss or losing that there's a negative connotation there, but when it comes to startups, losses are actually a part of the plan a lot of the time. They're expected and calculated and sometimes even encouraged by investors who don't really care about profits or losses as long as they can see a lucrative exit path. But I think it'll be easier for me to explain what I'm talking about here if I give you guys some examples of startups that have mind-blowing valuations that also happen to be consistently losing money. So these are India's top 10 loss-making startups coming up right after this. Starting things off at number 10, we have home services marketplace Urban Company, which offers professional home services to customers around the world. The startup's global expansion is one of the reasons why their losses nearly doubled between the financial year of 2019 and the financial year of 2020. Besides this, Urban Company spends a lot of money on differentiating themselves from the traditional home services industry. They do this by guaranteeing reliability, honesty, consistency, and professionalism across their workforce. This is something that they've been able to achieve with employee benefits, which made up 33.5% of their total expenditure in the financial year of 2020. Now, these losses were mitigated by the startup's 94% increase in revenue, but the real enabler of Urban Company's growth, of course, is their investors, who have pumped $445.9 million into the $2.1 billion unicorn over the years. Next up at number 9, we have fintech startup CRED, which rewards users for paying their credit card bill on time. But here's the thing. CRED is completely free to use, which resulted in their operational revenue for the financial year of 2020 being just 52 lakh rupees, which is a minuscule number when you stand it up next to CRED's expenses, which were 378 crore rupees. That means that CRED spent 727 rupees on every 1 rupee that they earned. These are huge losses, but CRED's investors believe in what they're doing. They believe that the startup will fundamentally change the way that Indian consumers behave, which is why they've pumped close to $500 million into the startup since it was founded in Bengaluru in 2018. Of these funds, $215 million were raised in April of 2021, bringing CRED's valuation to $2.2 billion. Moving on to number 8 now, we have Gurugram-based Delhivery, which operates in India's highly competitive logistics space. Now, back in 2019, Delhivery made headlines when their losses saw a more than 2.5x jump, from 684 crore rupees to 1,781 crore rupees. However, Delhivery's investors had their back. After the dust had settled, SoftBank led a $413 million funding round into Delhivery, and then later that same year, Delhivery raised an additional $265 million across 2 funding rounds from the Canada Pension Plan Investment Board. Since then, the startup has significantly cut their losses to 284 crore rupees, which is the lowest they've been since 2015. And they've taken this step towards profitability because they're actually planning on going public in the fourth quarter of this financial year at an expected valuation of $4 billion, which is $1 billion more than their current valuation of $3 billion. Coming in at number 7, we have Bengaluru-based B2B marketplace Udaan, which is a great example of what can happen when a loss-making startup doesn't have a contingency plan. Back when the COVID-19 pandemic hit in 2020, Udaan's business dried up. And despite the fact that they had raised $585 million in October of 2019, they were forced to lay off more than 3,500 workers. Now, how much of that $285 million Udaan had already spent in pursuit of growth prior to the COVID-19 pandemic is unknown. But what we do know is that in the financial year of 2020, Udaan saw its losses increase by more than 3x, from 779 crore rupees to 2,518 crore rupees. And while it does seem like they're back on track now after raising $280 million at the beginning of 2021, it's unlikely that the startup will soon forget the traumatic memory of what happens when growth is prioritized over stability. Next up at number 6, we have another startup that's been hit pretty hard by the pandemic, Ola. Ever since the financial year of 2017, Ola was actively working on reducing their losses in preparation for an IPO. Then though, COVID-19 happened, and Ola's plans to go public were put on hold indefinitely. They laid off 1,400 employees, their revenue dropped by 95%, and one of their investors, Vanguard Group, cut their valuation in half, from $6 billion to $3 billion. Unfortunately, through all of this, Ola's investors have been bearish. The startup hasn't been able to raise any funds since September of 2019. And while we don't know exactly what kinds of losses they've incurred since the pandemic began, we can safely assume that they're sizable. Now, Ola's parent company, ANI Technologies, has started to invest more heavily into its subsidiaries like Ola Foods, Ola Money, and Ola Electric, but the future of Ola Cabs is still uncertain. Moving on to number 5 now, we have food delivery startup Swiggy, which has seen its losses increasing dramatically over the course of the last 5 years. Now, one of the biggest reasons for these losses is poor unit economics, which is something that every Indian food delivery startup struggles with. In a November 2020 interview, Swiggy's COO was evasive when asked how much the startup loses on each order. So we can safely assume that Swiggy has yet to achieve positive unit economics, although that's something that the startup is working very hard to achieve. Now, this assumption would be in line with Swiggy's expenses, which were 2.3 times higher than their revenue, resulting in a loss of 3,769 crore rupees. But Swiggy's stakeholders don't seem to have that big of a problem with this number. The startup's investors have so far pumped $2.4 billion into the food delivery unicorn, which is currently valued at $5 billion. Coming in at number 4 now, we have Swiggy's rival Zomato, which saw a sharp increase in losses in the last 3 years after a period of loss reduction. But there's a couple of things about Zomato's story which differentiate it from Swiggy's. Firstly, Zomato is planning on going public. They filed their draft red herring prospectus in April of 2021, and from this prospectus, it was revealed that Zomato had actually achieved positive unit economics with a contribution margin of 22.9 rupees per order. Unlike Swiggy, Zomato is actually making money from food. And they've managed to do this by increasing their restaurant and customer fees while decreasing their spend on their delivery partners and on discounts. Of course, just because they've achieved positive unit economics does not mean that they're profitable. In the first 3 quarters of the financial year of 2021, Zomato lost 684 crore rupees, and according to their draft red herring prospectus, they're planning on losing more money in the future. Next up at number 3, we have the market leader in India's fantasy gaming segment, Dream11. Now, unfortunately, the latest financial records that anybody has access to from Dream11 are from the financial year of 2019, but going off of these numbers, it looks like Dream11 only spent about 15% more than they earned. And what's more, 84% of this expenditure was on advertisements and promotion. Now, when Dream11 first started in Mumbai back in 2008, investors were a little bit hesitant to get behind a startup that was offering what many people consider to be a gambling service. But then in 2017, the Supreme Court ruled that Dream11's games were actually skill-based, not luck-based. And this resulted in a series of fundraising rounds that totaled $785 million. Today, Dream11 is valued at just shy of $5 billion and is planning on going public in the United States in 2022. Moving on to number 2, we have Gurugram-based hospitality startup Oyo, which was expanding at an unprecedented rate in the years leading up to 2020. In the financial year of 2019, their losses totaled 2,332 crore rupees, which was a 5x increase from the previous financial year. They were operating in more than a dozen countries and had expanded into spaces like co-working, co-living, and rental housing. Then though, of course, the COVID-19 pandemic hit, and after a couple of months of bleeding money and hoping that the pandemic would end on its own, Oyo finally decided to start cutting their losses, which involved laying off thousands of employees, exiting several geographies, letting go of a number of properties, and focusing on keeping their core business alive. Now, understandably, Oyo hasn't released any information about the financial year of 2020, but what we do know is that they're trying to make the most of the pandemic by building a leaner company with wider margins. And finally, coming in at number 1, we have Noida-based fintech startup Paytm, which is planning what could end up being India's largest IPO ever. They're expected to file their draft red herring prospectus in July of 2021, but the question that everybody is wondering at this point is, will Paytm be able to achieve profitability before they go public? In January of 2021, Paytm's founder and CEO Vijay Shekhar Sharma had said that Paytm may be able to achieve break-even at some point in 2021 and profitability soon after, but so far, they're not quite there yet. See, Paytm's parent company, 197, saw their losses decrease by 42% to 1,701 crore rupees in the financial year of 2021, but they also saw their revenues decline by 11% thanks to the COVID-19 pandemic. Since the first wave, 197 has been actively diversifying beyond just digital payments. And so as these subsidiaries mature and as the pandemic dissipates, it's possible that 197 will be able to increase their revenue while further decreasing their losses. But we're just gonna have to wait and see whether or not this actually happens. All right, that was our list of India's top 10 loss-making startups. I hope you enjoyed the video, and if you did, please do leave a comment down below and let me know what your favorite part was. Also, it really helps us out when you hit the like button, so be sure to do that. And if you haven't already subscribed, now would be a great time to do so. We post new videos every single week about Indian startups, entrepreneurs, and the latest news. Thank you guys so much for watching this episode of Backstage with Millionaires, and I will see you in the next one.